Bernie has serviced the Columbia Union well over the past several years, has been in the investment business for nearly 20. And he's excellent at customer service and doing the job that he's hired to do. He understands our policy and he implements it well, and we thank you for the service that you give to the Columbia Union.
Thank you so much, Carol. I was watching you guys do your exercises, and I assumed you either were Adventists or Canadians because you were actually following all of the instructions. When we first moved to New York City, we discovered that people could tell we were Canadians because we actually stayed on the curb till the "Don't Walk" sign went off. And if you've ever been to New York, that was kind of the way to identify a Canadian, was they just listened to what you were saying. Actually, I didn't know you were going to do those exercises. I'm glad they did, because I had thought maybe I should start out with a topic like this to wake you up. But since you did all of the exercises, I could have probably avoided this. But actually, it does have a purpose in the topic, in that there are at least three, probably more if you want to think about it, great obsessions in America. One being sex, violence, 3, and money. And it seems that at the bottom of a great portion of our economy, people's interest either in investing, in marketing, is all driven through entertainment and all of these other things. 70% of the American economy is driven by consumer spending. I'm hoping that most of you have had an opportunity to go over the North American Division working policy on investments, because I know you get some wonderful speakers to come out and do those sorts of things, so I didn't want to spend the time doing that. So if you have questions about that, I see Mike's here, he can come up and do some of those answers in a little bit, but I'm hoping to do some other work on investments and leave that topic alone. For those who would have questions, I do understand it somewhat, and I think most of us aren't sure we understand it at all. But in case you do have questions later, I'll be happy to answer them. So since I couldn't talk on the other, or on all three of those topics, and I was certainly no expert on the other two anyway, I'm hoping I at least have some expertise on the money. I decided it was probably a good thing to talk about money. So we're going to talk about the investing as it pertains to the church. And I don't know how to talk about investing without also including a philosophy of money. So a portion of my topic this morning is going to be on the philosophy of money. It makes a difference how you view money and what it does for you as to how you make investment decisions. It's pretty much what we see driving so much of the world policies today, is what person's incomes are, what government debt is, how much money you can make from a career. Money becomes a very important part of every aspect of our life, and it starts driving that investment policy. So first of all, I want to talk a little bit about investing. And this is taking a look at a chart of the S&P 500. Going back a significant number of years, this takes you clear back to before the Great Depression. And when you look at a chart like that, you say, boy, don't I wished I had been invested in that the entire time. The unfortunate thing is that most of our investment horizons for our lifetimes typically run between 20 and 30 years, and depending on where you're employed for your policy purposes or other things like that, you may only be looking at an investment horizon of 10 years or less. And so when you see something like that, you say, yeah, that's great, but what would have happened, and since we're going to talk about interest rates too, what would have happened if just before or back around World War I on into the 40s we had invested? And I don't see that that's showing up quite as large as I had hoped that it would. But the actual numbers there would suggest that over about a 40-year period of time, if you invested at the high and didn't get out until that one low at the end of the red circle, you would have been dead flat for the 40 years, or pretty close to it. And you could have survived a number of the ups and downs and just been glad to had your money back. But then, of course, you see this real nice run up there into the 50s, the post-war era, and then you get another flat period of time, 20-some years, and you basically find that you were no further ahead at the end of 25 to 30 years than you were when you started. And for some people, that's their entire investment horizon, correct? Now, the other times, people get in on that great big run up and they think they're geniuses because, you know, they picked all of the right investments and it made them a bunch of money, and so they must be smart. And then we saw after the 70s, when everything began moving up very quickly into the year 2000, and it was just about that time, and this is kind of what I want to address a little bit of this morning. It was just about that time we began looking at, right around in here, changing how we viewed investments in the church. I don't know how many of you remember back quite a ways when if you went into CDs, people thought you were taking a great deal of risk because you had begun to invest in something. We've come a long way since then. The NAD policy has changed considerably, and a lot of the driving force, both in the markets and within the church and for institutions in general, was taking place as people began to study something called the Uniform Prudent Investor Act and modern portfolio theory. Those are things you've heard a great deal about. There's probably been, is everyone familiar with those topics? Oh, not enough. I was trying to skip some of that so I could get on with this, but maybe I should tell you a little bit about it. The restatement of trusts, which took place in 1959, the second restatement of trusts, actually began to make some suggestions and began to incorporate modern portfolio theory. Harry Markowitz was the author of modern portfolio theory back in the 50s. He ended up winning the Nobel Prize in the 90s as they began to recognize that if you diversified, if you used asset allocation, if you allowed for certain risks to be accommodated in building a portfolio, you could actually reduce your overall risk and improve your return. Well, that would apparently seem pretty easy to do when the market was going straight up, and that's pretty much when all of that policy was being adopted. I don't know if you remember how many of you were working for the denomination in the 90s or in the investment areas in the 90s, and that was just starting to come in, and the thing we heard about regularly was, well, if you would only allocate your assets across numbers of different asset classes, then you could reduce your risk and improve your return. And it seems like that worked out really well because the markets kept going up at a time when interest rates kept coming down. So you couldn't get quite as much as you used to get out of your bond yields, and you needed to go somewhere to get it, and so people began to look for ways of allocating. Now, I realize in a lot of our church policies, we don't even allow for certain other investments like equities or other types of mutual funds and trusts unless you do it directly through the GC's plans and policies. So not every fund that we have can actually do that. But that was that time period when all that was taking place. What's interesting, and I didn't put a little circle around it, is that if you look up here at the top of 2000, and some of you remember from 2000 to 2011, you were basically back to the same place that you were after 11 years. I'm not a prophet or a son of a prophet, so I can't predict that it's going to go 20 years or 40 years like it did back in those early days with something that is completely flat. But we are going to take a look at some scenarios and possibilities of what might be coming in the economy and with investments. Now, something that we're a little bit more familiar with is long-term interest rates. Interest rates have been all over the map as well. This goes all the way back to 1790. The actual average of long-term interest rates in the United States for about 200 years runs right around 5%. And that's not all that bad. If you have a 10-year time horizon again, and a lot of the portfolios that you would work with would certainly have those 10-year time horizons. And let's say even back here around, say, the Vietnam War, you bought a 10-year bond in 1970, and 10 years later in 1980, the interest rates were clear up there near the top. And so your bond matured, you bought another bond, and you got great interest rate. And then when it matured 10 years later, you got another 7%. Don't we wish we could see those yields now? Well, we're not seeing those kinds of yields. We're obviously in a much lower interest rate environment. And on the 10-year Treasury in particular, because this is one of the areas that we have focused in on from denominational investing and from institutional investing. What's your cash flow? How long do you want to take for an investment before it matures? And how much can you actually get for a yield? Well, if you look at the 10 years here since 1945, at the 10-year bond, this is post-war. From 1945 coming right up to 2011, hasn't changed much between 11 and 13, but I found this chart and it happens to do the picture very well. Look at the way that yield curve looks. Straight up and straight down. So what happened to asset allocations if you had blended your portfolios like we were recommended that we should do? Well, in the 36 post-war years when yields were rising out of that 68 years, you would have had about 12.5% if you were in stocks, and your total return would have been negative if you were in bonds. Not very encouraging. Now, mind you, if you had bought a 10-year bond and held it to maturity, you would get your 8%, 7%, whatever the case may have been. But the total return, because bond values deteriorate when interest rates skyrocket, the total return would have been less. But look at what happened in the last 32 years, when you could have actually gotten a 15% by owning the 10-year bond and beaten out the entire equity market. So you would have actually done better just owning bonds in the last 30 years. Yes. Yeah, that's all we need, is just to be able to figure this out before. Because the question is, if you've got that big of a diversity over 60 years, for people who were working in investments for the 30 years prior to the peak, they felt bad about the way things were going in their portfolios. For the people who owned it in the last 30 years, they felt pretty good. Here's an interesting picture called stock-bond correlation. When you build a portfolio, you look at things, if the bonds are going up and the stocks are going down, or if the stocks are going up and the bonds are going down, you want to blend your portfolio together so that you don't have everything going up at the same time and everything going down at the same time. That's called correlation. That's part of building that efficient market and getting it to work right for you. So here you can see that since 1945, the actual correlation has been positive almost half of the time, which means they've gone in the same directions as each other. You haven't been able to offset any risk. Well, that would be troubling, because that's what you're trying to do. Now, this is a picture of what's called the efficient frontier. Let me use the one over here. If this was 100% bonds from 1948 to 1980, and you ran this with different blends of stocks and bonds, and this was 100% stocks up here, you can see that the 100% stock portfolio got you the 12%, but the 100% bond portfolio didn't do you very well at all. But look at the last 30 years. In the last 30 years, 100% bond portfolio and 100% stock portfolio almost identical. For taking zero risk, you could have gotten the same return as taking great risk. In other words, the risk premiums over the last 30 years have not paid the investor back. Now, that's not news to any of us who have a 401k, 403b, or any other type of investments, what we have all discovered over the last 30 years or so in our investment career is that the market hasn't always treated us as well as the promise of the broker who sold it to you. I would guess that's a fairly true statement for everybody. That's because we've had such a tremendous change in interest rates and in where those risk premiums get allocated to. What does that have to do with conference investing? Well, unfortunately right now, how many of you can get an interest rate above 5%, which has been the average 30-year bond? Right now we're still below 4% on the 30-year and below 3% on the 10-year. What are you doing with your money to try and get a return? Well, you're struggling. And the problem that we have is the only thing we can possibly consider that we might be facing is either continued low interest rates, or if they start going up, what's going to happen to the bonds that you own? They're going to start deteriorating in value. So it doesn't look pretty for us going forward. Well, what might happen? Well, let's take a look at what happened over in Japan. Now, I can't promise you that things are going to work out as they did in Japan, but about 1994, a good, about 14 years before our financial crisis in 2008, they peaked out. They had begun to come back down, but that's where their financial crisis began. They undertook essentially the same policies that our government has undertaken in order to try and stimulate the economy. And you can see what's happened to their equity market. And I didn't put up the Japanese bond, but I can tell you their interest rates are also still at 0. And they've gone from 1994 to 2013-14 and haven't been able to get out of their own way. Now, that's not a guarantee that that's going to happen with us, but I can tell you that the fiscal policies and monetary policies of this country have reflected very closely what took place over in Japan. You might expect that that could be a similar, even if not identical, return to what we had seen. That's going to create some real problems for us as we go forward. So how do we make these investment decisions? What is it that causes us to make an investment decision? We have two policies that you've probably heard a great deal about. The first one is the Prudent Investor Rule. That's the restatement of trusts. The Uniform Prudent Investor Act. That was the one that really took most of the publicity in the 90s as people became more familiar with building portfolios within the church. I think we had a number of different presentations. Both Roy Ryan and his predecessor did a great deal to try and inform our unions and conferences about investment policies, how to write investment policy statements, how to build portfolios, and how to use the general conference investment services if it became necessary, or that's what you chose to do. To do that, and they were based on these laws and premises. The Uniform Prudent Management of Institutional Funds Act is actually the act that has more to do with you. So even though the Prudent Investor Act, which deals with trusts, certainly has something to do, well, I think every conference pretty much has trusts, and I know that the union offices for sure do. You're responsible to the beneficiary of those trusts. However, the Uniform Prudent Management of Institutional Funds Act, which was just adopted in 2006 and has now been adopted in every state except for one, and I'm sorry, Ron, but that's Pennsylvania, the only one that has yet to adopt it. They do have some other laws that basically give that same consideration, so they didn't necessarily have to adopt it, and that's why the state's been slow to legislate that one. You'd be able to look these up on the internet and get them. They are the legal force for institutional investors. They are the ones that outline the law. Matter of fact, when you actually look at the two of them, there's the Prudent Management of Institutional Investment Funds Act, there's Uniform Prudent Investor Act. When you actually go out there on the internet, look up the law and then read the law, you find that there's a great deal of similarities between them. But there's also some substantial differences, and I want to draw your attention to them because the church has been very careful to draw some of its policies even prior to an adoption of the Institutional Funds Act. And they've drawn some of their policies that help reflect institutional investing just as the law would suggest that it should. If you look at the Uniform Prudent Investor Act, and I realize some of these things are more exciting for me than they are for you, you know, so I hope I don't put you to sleep. That's why I was glad they had all those exercises out there. But although the Uniform Prudent Investor Act is by its terms applies to trusts and not to charitable corporations, except for the trust that you manage, what are most of your funds? You'd fall under that charitable organization. You're a nonprofit. So the Uniform Prudent Investor Act doesn't actually apply to you, except as you may be administering some of those trusts or as the union might. Implications for charitable and pension trusts. This act is essentially concerned with the investment responsibilities arising under the private gratuitous trust, which is the common vehicle for conditioned wealth transfer within the family. Okay? You don't deal with that much. Now, I realize that a lot of the investment policies that were originated back in the 90s dealt with the Uniform Prudent Investor Act and not with the Institutional Funds Act. So that's why I decided I'd bring to your attention what the Uniform Management of Institutional Funds actually has to say. The duty of loyalty is perhaps the most characteristic. Who do you owe your responsibility to? Well, in the case of a trust, you owe it to the beneficiary, right? Who do you owe your loyalty to as a conference? Who gave you the money? The members, okay? The gift instrument. What's the gift instrument that you folks would suggest best is applied to the funds that come to you? Probably the tithe envelope, or however that money was designated to end up in the conference coffers. By the time it gets there, that designates what you're allowed to do with that money. You don't have freedom, complete freedom. You are responsible, according to the law, to do what is right for your constituency. This is one of the reasons why at the beginning I said when you have investing and a philosophy of money, there's no way that you can separate the two. Those people who gave you that money had a very specific philosophy of money and why they gave it to you, which is why they stuck it in the tithe envelope to begin with. So it changes the way we view our responsibility in the funds. Fiduciary cannot be prudent in the conduct, the last red line there, of the investment functions if the fiduciary is sacrificing the interests of its beneficiaries, or in the case of the institution, if you're sacrificing the best interest of your constituency, your church members. So here's what the Institutional Funds Act actually says as a standard of conduct. It is subject to the intent of the donor. And I'd recommend that you look this up and print it off for your own state. And it's not a long document, but as you read through it, it really designates what your responsibilities are if you're going to be involved in investing. In some cases, like Carol at the conference, you depend on me to read that and then suggest that this is how we stay within those lines and defined within the NAD policies. And that's good too, because one of the things that they give you permission to do, I should have backed up that. This was actually before they revised the act in 2006. It's called delegation. And the institution is not only given the right, but given the fact that most people in an institution don't necessarily or aren't necessarily hired for their expertise in the investment area, it becomes your legal responsibility to hire somebody who is, or to have somebody do that money for you so that you're not responsible. I'm not suggesting you aren't responsible, but you do want to shed some of that fiduciary responsibility and share it with someone else who has the professional expertise. And that's what this says. So here we have, subject to the intent of a donor expressed in a gift instrument, an institution in managing and investing an institutional fund shall consider the charitable purposes of the institution and the purposes of that fund. What's your plant fund for? Well, you know what it's for. That really defines where your investments are. You're not a stock market investor. Is that right? No, because it's a plant fund. An association fund. You're not a stock market investor. You're endeavoring at all possible costs to preserve the principal and at least be able to stay above the inflation rate. Now, the biggest concern right now in the economy, if you've listened to Ben Bernanke, and I see that Janet Yellen is already starting to pick up the mantle, the biggest concern on the part of this country is deflation, not inflation. If you actually look at the amount of money, I saw a statistic yesterday, did you know that the Federal Reserve now owns 50% of all Treasury debt outstanding? The Federal Reserve owns 50% of all Treasury debt outstanding. The fiscal policies of this country and the way they've printed money and endeavored to monetize the debt could potentially be leading to exactly the sort of thing I was showing you in that chart with Japan. So it's not trying to, I'm not trying to predict it. I don't know what will happen. I mean, in the end, we all kind of have some idea that, okay, everything falls apart and collapses and we go to heaven, right? So we all have that understanding. But we don't know when that is. But it could get a lot worse before it gets a lot better. Okay, so just being cautious is a good thing. Here's another thing. Except as otherwise provided by law other than this act, an institution may invest in any kind of property or type of investment consistent with this section. So here it turns around and goes right back and says, yeah, but you could actually invest in anything. But look at what I highlighted in the next red line. An institution shall diversify the investments of an institution fund unless, and this is important, the institution reasonably determines that because of special circumstances, the purpose of the fund are better served without diversification. Now that is a huge difference between that and the UPIA, Uniform Prudent Investors Act, and the restatement of trusts, because there you're responsible to the beneficiary. The beneficiary can come back and get you. Here, your institution, the church, the conference, the union, and those that you invest the money for, you're responsible to them and the donor who gave that money to apply those investments as they asked you to. You don't have the free right to go out and do something else in order to seek a higher return if they didn't ask you to do that. Okay? So this is what the law now says in 49 of the 50 states. This is the general law that they put together, and then each one of the states adopts their own and adds some of the additional policies. I don't know if any of you guys want copies of that. If I end up with your email addresses, I'll just be happy to email it to you. And you won't have to go looking it up. But they are all available. And since... where's my friend Vanessa? She said I was supposed to have 5 questions. Well, one of them was the Uniform Prudent Management of Investment Funds Act. If you're supposed to know what the, I didn't make it a simple question. What's the legal act for institutional investing? So if you want to get that question right, mark somewhere on your paper. Oh, is this cheating? Oh, are they? Well, anyway, UPMIFA, that would be the right answer, okay? Because I wasn't sure if anyone saw, I didn't see anyone taking notes, so I figured I better tell you what it was. There was actually one in there that I realized I didn't get into a slide, and I was going to mention it anyway, but I might as well tell you now because that's one of the questions too. So I'm just giving you a heads up. What is biblical prosperity? Do you know what biblical prosperity is? It's having what you need when you need it. That's all it is. The prosperity gospel that's popular today in America bears very little resemblance to good biblical theology. Biblical prosperity, and I get this one from a good friend of mine named Ed Reed, is having what you want or having what you need when you need it. Okay? And that's all. Not before, not after, not too much. And I'll cover some of that in the philosophy of investing. After we get done with the real boring stuff that I'm going through here, there's actually some other stuff that's actually interesting. But how do you determine then what you're going to put together for the pool of investments that you have? Has anyone got an idea what that would be? How do you figure out what that is? What controls, besides this legal act, that's the legal act, what do you do in your department when you get a pool of money and you need to invest it? Well, that's a good idea, but you got to start somewhere even. Of course, I've encouraged this, and you folks have done it. I know you have. I know Ron has. I know Kerf has, because we've encouraged this. Write an investment policy statement, an IPS. Write an investment policy statement. What is the purpose? If you want some sort of outlines, you can get all kinds of outlines on the internet. If you want some from me, I'll be glad to share them with you. You know, I'll share you all assess, you know, and then you'll know what they are. So, but that's how you determine on these pools of money that you're being asked to administer. Because then you can defend yourself to the NAD and to the audit committee when they show up and they say, well, why do you own that? And you say, my investment policy statement says, now you probably ought to stay reasonably compliant unless you get special permission from Seth and from Tom Evans. You probably ought to stay reasonably compliant to the NAD policy, okay? The law is one thing to answer to, but you know, nobody wants to have to answer to Tom Evans. So we'll try to offset some of that risk for you. See, I need to keep going here. Oh, we were going to talk about modern portfolio theory because I had brought that up. This has really driven the investment markets for the last probably 30 years, almost that entire 30-year period, interestingly enough, that we've been seeing interest rates going down. When he wrote the original modern portfolio theory, and it wasn't Stirk who wrote it, by the way. Stirk is a Cornell professor that has written some very interesting articles recently about the modern portfolio theory, because the problem is what modern portfolio theory predicted would happen only worked for a short period of time, and then in this last 30 years in a declining interest rate environment, it doesn't seem to have paid off. Now, it's not because it wasn't important. It's always good to diversify, to allocate, and to spread your risk over multiple asset classes and multiple investments, right? I mean, by now, I think we all know that. Don't put all your eggs in one basket, whatever the saying is that you want to have. But the problem is that the average investor, even institutional investor, and we've seen this at Harvard, Princeton, CalPERS in California, and all of the major institutional funds are no longer being compensated for the risks they're taking. Okay? They go out. Apparently, everybody actually started to buy into this theory. So what the theory said was that there was nothing wrong with adding a stock if you only diversified it so that it wasn't the primary holding, and if it brought some additional growth to your portfolio, you could offset the risk by some of the other investments that you owned. The problem is now almost everybody owns stock. If you look at a 401k, everyone's invested in stock. The stock market has become so saturated that it no longer is paying a risk premium. However, it does seem to have a very negative problem every time the market goes down on people's portfolios. So although you're not benefiting greatly from this increased return, it sure seems like every time you've invested in the market, you have benefited from the downturns. Well, I guess that's not a benefit, is it? No. But anyway, you always seem to participate in those. So modern portfolio theory has helped us a lot, but according to what Professor Stirk at Cornell says, it's not as prudent as it used to be. Uh-oh, I just shut something off there. Oh, there it is. Well, this is a miracle. And those charts that I showed you just earlier actually go to proving that. In the 30 years prior to 1980, you can see that the efficient frontier works very well, just like modern portfolio theory predicted it would. But in the last 30 years, it hasn't worked out at all. Where do we go from here? Well, in the 30 years that you see the great big spike up there with that first red parenthesis at the bottom, as you're looking at that climbing great return in the stock market, actually interest rates were going sky high. As interest rates came down, you have the same scenario. So the change in interest rates doesn't appear to have made any change at all in how the stock market performed. Stock market performed every bit as well here as interest rates were going up as it did when they started coming back down. Well, that doesn't seem to make good sense either. Well, part of that is showing up in the fact that over this last 30 years, you've had continuing stimulus after stimulus after stimulus. And even though from an inflation rate, they're still suggesting that we are deflationary or close to it, we're producing so much money that it's inflating the assets. Okay? There is a real risk of certain asset bubbles taking place, just like we had with real estate earlier. Well, I'm not going to spend any more time. Any more questions on investing? I know that's probably as exciting as milking cows for most of you, but if there's no questions, I want to move into the philosophy of money in the last few minutes I have here. I'll be glad to answer any questions at the end, too, that you have. But Georg Simmel was a German philosopher from the 1800s. Interestingly enough, lived right up through 1912, kind of at about the same time period that this church was being founded. And he wrote a very interesting book called The Philosophy of Money. And the upshot of his book was this. He saw money as a component of life that helped us understand the totality of life. You know, I remember listening to one of my business mentors, Jim Rohn, and he would say, money is not the best way to measure your success, but it's not a bad place to start, okay? Because it is a way of defining how things have worked out for you. Here's a few other things he said, and I think these are really worth looking at. As money and transactions increase, we're just talking about a philosophy. By the way, he had a lot of money, so he had time to sit and think of this. His father was a candy maker in Germany, and he ended up with a nice inheritance, and he could just sit around and think about his money. So as money and transactions increase, the value of the individual decreases. And everything becomes about what the individual can do instead of who the individual is. How many of you have seen that? Another negative effect of money is the effect it has on people's belief. Everything boils down to dollars and cents instead of emotional value. I mean, we could not agree more as Adventists on some of the detrimental effects of allowing that one obsession here in America, money, to control the way we make decisions. Okay? Having a good philosophy of money becomes critical to how not only do we invest, but how do we deal with the broader topic of money in general. One of my favorite authors, those of you who recognize HMS Senior, once wrote, talking about money, the worship of the golden calf is very popular today. We need some plain teaching on this subject. The subject of money is a ticklish one. Talk about heaven, talk about hell, talk about things long ago and far away, but don't talk about my checkbook, my bank account, my property, or what I do with my money. But why not? These things represent life. In a sense, money is congealed life. And the reason I put his on here is it comes right on the heels of what someone 100 years ago had said, a complete, well, not totally atheistic, but a very secular philosopher in looking at money. How do you use it? How do you consecrate it in the secret temple of our hearts? Many of us still worship the golden calf. That's from his book, Walking Through the Bible, page 46. So money is a measuring stick of life. It's how you measure your work. It's how you measure value and values. It's how you measure your priorities, integrity, your spirituality, your self-sacrifice, and your commitment. So glad Seth had the presidents here, because they basically were saying this same thing. They laid the groundwork for the fact that your belief and how you handle money becomes critical. And it's very important for us who, or as you folks are, who then represent to your conferences what the church is doing with its money. How committed are we in what we do with our money? And I found this out in working just with private investors. Money can be a difficult topic to talk about. Here's another quote. Money itself is the gift of God to men to be used with fidelity in his service. But it's the next one that I wanted to do. And some of you who've seen some of my presentations may have seen these quotes before. Money has great value because it can do great good. In the hands of God's children, it is food for the hungry, drink for the thirsty, clothing for the naked. It is defense for the oppressed, and a means of help for the sick. But money is of no more value than sand, only as it is put to use in providing for the necessities of life, in blessing others, and advancing the cause of Christ. Oops, I hit the button again, didn't I? Was that the last slide? Oh, okay, good. And that's why I hit the wrong button. Yeah. I couldn't remember which one I ended on, because I had another slide and I didn't put it in, and that was the one that had prosperity. You remember that one, right? Because it's going to be on your test. But the philosophy of money really makes a huge difference in what you do on a day-to-day life. And I don't know, when Seth wrote to me and he said, I want you to talk about investments, how they pertain to the church and things like that. And then he put something in, he said, I want to talk to you about your own testimony. And I have a very difficult time talking about myself because I just feel uneasy doing it. But I'd done a lot of seminars and things like this and camp meetings where we talked about stewardship and money and investing and all sorts of stuff like that. And I would always read these great sayings. And then I would start thinking over the next year from camp meeting to camp meeting, so what are you doing with your own money? And you know, it's one thing to sit up here and preach it, it's another thing to sit down and actually do something about it. And so my wife and I determined a few years back that we were going to do something about it. And I had a nice big house on 7 acres with horse pastures and barns, and this was my idea of how I wanted to live and retire. And the amount of money that it cost and what I was putting into it did not match my philosophy on money. And I realized I was a hypocrite because I was preaching one topic and living something else. So we sold the house. It wasn't always the best market to sell it in. And we moved from something over $300,000 down to a $60,000 house. We moved from living out in the country into living in town, from driving new cars to used cars. And I took the rest of the money that we saved and I began helping people with it. And it was not always tax-deductible receipts. Right now, probably over 50% of my income goes out to helping other people. And most of it is not tax deductible. I do give to the church and things. It made a huge impact on my life. I've spent what I had saved. I'm not suggesting everybody do this. I've still got a reasonable income, and I still have some expectations of what my wife retired, and she has a pension. But it really changed how I lived. And it's one thing to tell people that you believe in these principles. It's another thing to put them into practice. And I've found, by and large, I'm not going to tell you what you should do with your money. I don't think everybody was ever called to be like the rich young ruler, go sell all you have and follow me. But I think given what we have done here in America and those three obsessions, and many of the obsessions in particular in America, of consumerism and money, we may preach self-sacrifice, but most Adventists don't live it, including myself. And I realized that if I wanted to be honest with God, I had to make a change in the way I was living. And the only way to do it was just to sit down and do it. And it wasn't comfortable, it wasn't easy. But I have found that prosperity is having what I need when I need it. And God has never let me down. I can remember before I got in this business, not having any money and finding a way to put 4 kids through the academy. After they were done, and after being in this business for 20 years, I had more money than I needed. And I wasn't doing much with it other than spending it on myself. Now, that's only the way it was working with me. That may not be the way it's working with you. But I would challenge each one of you as treasurers and as church members to sit down and review how you're spending your money. What is it that you want to do with the resources that God has given you? Because outside of taking care of the necessities of life, helping others, and promoting the gospel work, the rest of your money is as worthless as sand. And I can tell you from personal experience that God can take it away from you as fast as he can give it to you. And what he has given to you, he has given to you for you to use for the purposes of others. If your needs are taken care of, I'm sorry, am I preaching now, Seth? Okay. If you have taken care of the necessities of life in your family, then the other resources you have, God has given you to use for somebody else. Okay? Any questions? That was all I had in my presentation.